What are you thinking in terms of where oil prices head? Are we going to $80 or are we capping out here?
Well, thank you so much for having us. It is the Brian Show, so it's great to be on with my colleague, Mr. Levitt. I would say this, energy is a tough sector, and you're going to remember a year ago, energy companies were paying you to take delivery of oil, and I love the perspective of being 3% of the market. Remember, you just buy Apple, and it's larger than the entire sector. But I think what's interesting on a stock-by-stock basis, and that's really the theme that you have to consider, Caroline, is that the market is a market of stocks. And I think that we have spent too much time talking about sectors and macro. I think we've entered a more of a stock-picking type of environment. And we think energy is going to be troubled here, especially given the fact that a lot of the value outperformance has been these down-and-out energy companies that have not earned money, that are negative cash flow, and have really had trouble paying dividends and delivering earnings. So a lot of the companies in the U.S. are dependent on this higher oil price. We actually prefer Canadian oil companies relative to U.S. companies. And if we were shorter-term traders, which we're not, we would be selling our energy positions here and focusing more on those companies in the U.S. that are dividend-oriented, income-oriented, and less dependent on the price of oil.
Interesting. So, Brian Levitt, your perspective, therefore, we've all been so caught up in the market about what leads the charge. Is it value versus growth? It seemed like last week we got back into our growth vibes. But do you think of the market like that at the moment? Does it matter on a sector level, or are you more focused on the individual names, as Brian Belski was saying?
Well, I do tend to look at it from a regime perspective. And so we had a very sharp recovery. And within a recovery stage of an economic cycle, you tend to see the more value-oriented, deeper value parts of the market, the really cyclical parts of the market outperform. Once you get through that and the economy is above trend and still accelerating, you move into an expansion phase of the cycle, you tend to see value stocks tend to do well, but growth stocks also move to the fore. And that's precisely what we're getting over the last weeks. Now, what investors should start to recognize is that we're heading towards a slowdown at some point as we head into 2022, and the markets are already going to be assessing that. Now, a slowdown sounds ominous. It's not ominous. We're growing at very extreme levels right now, given the disastrous outcome. Economy will slow down. You'll be back, in my opinion, favoring structural growth businesses over deeper value cyclicals.
Is there still structural growth, Brian Belski, in the likes of Amazon, Apple, Microsoft, Facebook, Nvidia? I read those names off because they are the biggest point contributors to the S&P 500 this morning.
Yes, the short answer is yes. And I think what's going to end up happening with this growth and value debate is, can't we all just get along and be friends? Because I think you want to own both. I think you want to be roughly equal weight both. And in fact, we've been saying that all year long in terms of being equal weight growth and value, and across the market cap spectrum as well, large, mid, and small cap companies. So, but from a secular basis, there's several sleeves of tech stocks. There's four, the way we look at it. And we want to be in those secular growth names. Brian called it structural, but you can also call them secular, whether or not it's Apple, Nvidia, Amazon, which is technically a consumer discretionary name, or Netflix, Facebook, in the Google machine, as I like to call it. I mean, these are the names that we're spending our money in as a society, and we think they're going to continue to grow longer term.
Structural, secular, it's my tomatoes. Brian Levitt, your take on, is this market really complacent right now? We're at record highs once again on the NASDAQ. We're near record highs on the S&P 500. We've got a VIX at basically 15. Is there anything in the market, is there any signals to you that we're ignoring some big risk coming in the future?
No, I don't think that this is a complacent market. If anything, investors should expect to see new highs over the course of their lives. Since the S&P 500 came out in 1957, you've had a new high once every 15 days. So there's nothing particularly frightening about new highs. But you ask about complacency. I think the risk is, as always, with regards to volatility in markets, is there going to be a change in policy or some type of policy uncertainty emerge? And what you may see over the course of this year into the beginning of next year is some concern about Fed policy. We saw a little bit of it in February. We certainly saw it in 2015 and 2018. As the Fed starts to shift policy do we have to see what we would call the freak out moment, a bit of a flattening of the yield curve, a stronger dollar, a bit of a drawdown in equities? I suspect we will see that. To me, it would represent a buying opportunity. I mean, as we all know, it's not the first Fed move that matters. It's the last one. And I think we're still early stages of a new cycle. But yeah, you're likely to see that play out as the Fed starts to normalize policy at some point over the next months.
Brian Belski, are you hedging your downside here?
No, I mean, we're going to be more worried when people are more bullish. I mean, the majority of our institutional clients around the world are negative, and they're doubting this bull market. We've had a call for the last 12 years that we were in a big structural secular 20-year bull market. And we think the second half of the bull market started last March, and we've been on record with that. And we think that's going to continue. In terms of complacency, there's this whole notion that when growth is scarce, growth outperforms. The market's not scarce with growth. We're still seeing double-digit earnings growth. That's why I think you need to be in the best high-quality growth and value companies going forward. So the market is far from complacent. We're still trying to get people to buy equities and understand stock picking. And I think that's still very, very early innings of a baseball game.